Hi, this is Dr. Tom Gerard, and we're in the middle of our Introduction to Financial Accounting course. And in this section, we're going to introduce the idea of accounting for long-term fixed assets. And we have to be able to define what a fixed asset is, classify fixed assets, and account for the cost of the fixed assets. We'll also discuss the three different main methods used for depreciation of those fixed assets. Okay, we're in part two of talking about depreciation expense, and you'll see here that what this little diagram is showing you about our little forklift example is that every year for the useful life we've determined the three things, right? Let's go back. We know the initial cost was $24,000. The residual value we're estimating as $2,000, and the useful life that we're going to depreciate this asset over is 5 years. So regardless of the method of depreciation, we would have 5 years of depreciation expense. So the first one that we're going to talk about is straight line depreciation. Now straight line, well, here's the three: straight line depreciation, units of activity depreciation, and double declining balance depreciation. And straight line is obviously what we really think of when we think about depreciation, because it's basically taken the depreciation expense, because remember the depreciation expense is our cost minus the residual value divided by the years, and that's $4,400 in our forklift example. And here's each year we would have $4,400 expense, and it would be straight line, meaning the same amount every year for 5 years. Now at this point I do want to mention real quickly that the depreciation that we use for financial statements and depreciation that used for income tax purposes are not always the same. And because tax law is divided, tax methodologies are determined by tax law, and what we're talking about here is for the financial statements, which is we're following GAAP, or generally accepted accounting principles. Okay, so straight line, same amount every 5 years. Now the other thing that we comes into play here and that we're going to see is we have that contra account. If you remember, when we expense depreciation, we just don't decrease the depreciation account. We add a new account to our chart of accounts called the accumulated depreciation. And so we always have the cost of that asset, and then we have the accumulated depreciation. Here it says the difference between the fixed asset account and the accumulated depreciation is the book value. So we talked about that in an earlier chapter. So the reason why it's brought back up here, because we'll see a little diagram on how those two things change depending on the depreciation method that we use. So for example, now here's our book value, for example, of the forklift after the first year. Book value, we pay the whole expense value that is $24,000, and the first year we've depreciated $4,400, and so here's our book value. If this company went into bankruptcy or something like that, and again, this is not a law, I'm not a lawyer, but you know, they're going to look at the book value of the business. If you ever heard somebody, well, what's the book value? The book value of this asset after the first year is $19,600, and remember, it includes that residual value because it still has that $2,000 value in this book value. Okay, even though we're not depreciating that $2,000. Okay, so here is where I wanted to show you this, because we're going to look at this little chart for each of these different methods. Here's the depreciation expense each year, and here's the book value. And this is, again, straight line is the most easy to understand, what we kind of think of. Same amount every year. As you can see, these bars exactly the same for each of the 5 years. But you'll notice over here the book value, it kind of goes down at a 45-degree angle or something like that. It's very, very specific, right? You see, bam, bing, 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 okay? Now, the next one we want to talk about is the units of activity. So if you're buying a piece of equipment or even maybe a vehicle, and you're going to determine that this vehicle loses its useful life based upon the amount of use. And maybe that amount of use varies from year to year. And I'm trying to think of a good example, but maybe we're building, we're a construction company, and we're building a skyscraper, and we've bought a crane, right? And the first year we've bought this crane because we're going to be using it for setting up the foundation of the building, and so we don't use it. And maybe the second and third year, this crane is going to be hauling heavier and heavier stuff during the main construction of the building. And then at the end, now remember, this is not about the cost of the building. This is the cost of this crane, right? For the crane operating company, not the building people, the people that own the building. So basically what I'm saying is, in the early year, maybe we don't use it very much. The second, third year, we use it a lot. And then in the fourth and fifth year, maybe we don't use it as much again. So in other words, the units, maybe it's a piece of machinery, and it says, well, the life expectancy of this machinery is so many units. In other words, machinery meaning manufacturing piece of equipment. It's supposed to make so many widgets in its lifespan of 5 years, and we don't. And maybe sometime this year it makes this many widgets, next year it makes that many widgets, and the year after that it's a different number. So it's not straight line. It's based upon the units, and the units here, as you can see, hours. Again, going back to my favorite topic. I don't know why it's my favorite topic, but because I'm partial to service businesses, I guess. The lawnmower. If you bought a lawnmower, zero turn, or they've got an hour meter on it, right? You change the oil after so many hours. And you may use it a lot this year, and you may use it less next year, right? The miles driven or quantity produced, how many widgets. So it's about that. Okay, so here we have to determine the depreciation dollar amount per unit. So here's our total cost. The depreciation per unit is the total cost minus residual value, that's my 24,000 minus 2,000, divided by the total estimated units over that 5-year period. Okay, and that compute the depreciation expense. So we're going to take that that per unit depreciation cost expense, I should say, and we're going to multiply that by how much we've used it during that period. Now here's a lot of words on this slide, but we're going to say, and I got it kind of highlighted in red here, what it's saying is it's the same forklift, but instead of using the straight line, we're going to use the units. And it says the useful life is 10,000 operating hours over the life. During the first year, the forklift operated at 2,100 hours. So 10,000 divided into the total depreciation expense is $2.20 per hour. So what is the depreciation expense for this first year? 2,100 times $2.20, right? And here's a formula down here. Answer is 4620. And you can see that's a little bit more than what we had on the straight line. Now this is just, again, this is just showing you how much it was used from year to year to year. And where it really shows is when we look at this little chart. And you'll see now, here's our 2,100 this year, 1,500 that year. This is the forklift. How many hours it was used? 26 that year. So what you'll see is each year it was a little different on how much you actually used the forklift, how many hours. And now you look at your chart and it's like this, right? So this year we wrote off 4620, that year it was 33, and this one is 5720. And you'll see that this is kind of a, straight across, right? But you'll look over here on my accumulated, my book value. The book value is still going down. It's just not going down at a specific amount each year. It's going down by that, how much we've expended it, right? Okay. So the next one is double declining balance. Periodic expense over the expected life. Okay, so now this is a different one. So first of all, in this one, double declining means we're going to be able to double it up in early years. So determine the straight line percentage, which was the first one we did, right? Determine the double declining rate by multiplying the straight line by 2. Okay. Then compute the depreciation expense by multiplying the double declining balance times the book value of the asset. Oh boy, that sounds complicated, but it's really not. Take a look at this. Whoop. Our straight line depreciation was 20% a year, right? Our double declining is going to be 40% a year. Okay, so we've doubled this is double declining, meaning we've doubled our 20%, our straight line, and then we multiply that. Then we multiply that times our cost, and that's going to do our cost of the depreciable cost. 40% times the 24,000, because that's up here, right? 24,000 times 40% instead of 20. This is the first year. 40%. And then we'll see, here's where it is. 24 times 40% is $9,600 depreciation expense, right? And then here's the book value. And this is a little chart. So the next year, 40%. Now you'll notice on this particular one, when we get down to the 5th year, there's not even 40% left. So it's 40% a year, double declining. And in the last year, it's less, okay? And then let's take a look at the chart, because this is where you can really see it. Look at how much we've depreciated the first year. Now, you'll see, now again, there are advantages and disadvantages to this, and it just depends on the organization on why they would use something like this. For income tax purposes, which they have a modified depreciation, that's very much like this, accelerated depreciation, modified accelerated depreciation, I think they call it. And basically it's because you're getting a big tax write-off the first year, right? And it's to encourage businesses, the tax code, to encourage businesses to buy assets and to buy new assets and lower their tax liability, and means more money in their pocket, right? So you'll see that this is kind of again, the expense is higher the first year, and it's not steady. It's not by unit. It's still a percentage calculation, much like the straight line, but it's doubling it up 40% instead of 20 until you get to the last year when there's not even 40% left, and that's the 5th year is just whatever's left. Okay. So that's all we're going to talk about on this particular section, and then we'll look at some more depreciation ideas as we go forward.